The Financial Sense Friday edition with Jim Paflava. Focusing on precious metals and mining.
Dave Morgan joins us next from the Morgan Report. Dave, one of the things I want to hit, last time you were on the program, we talked about the parabolic rise in silver, and look out when it gets silly like this. Something's usually going to happen. Okay, we're talking afterwards now, and something did happen. We're down in the 34 range, but you were talking about silver over 10 years ago, and now there's all this talk about this 16-to-1 ratio from a lot of Johnny-come-latelys. So where's that number come from, and is it a legitimate number if I'm looking at the silver market?
Well, it is and it isn't, Jim. On my early lectures going back a decade or so, I put a chart of the gold-silver ratio up, and I got it from Franklin Sanders, by the way, so let me give him credit. Started from about the 12th century to, in that book, I think it goes through 1980. And the 16-to-1 or 15-to-1 ratio is what I call the monetary ratio. That was when both silver and gold were both money. It's bimetallism. It's where both silver and gold are traded, not really in a free market, because it's dictated that 16 ounces of silver buys 1 ounce of gold. And that's the monetary ratio. But what I call the natural ratio, and what you're implying and what I'll make hopefully very clear, is that many people on the internet state that the natural ratio, the ratio out of the Earth's surface for silver to gold is 16-to-1. That's not true. That's the monetary, or what I call the classic ratio. The natural ratio, the amount of silver to gold in the Earth, as far as we know from all of recorded history, and this is another point I'm going to emphasize, so I'm digressed in a bit just to make it very clear. There was a lot of articles about how much silver exists. Well, this is from a study produced by Charles Rivers Associates. It's quite old. I think it was 93 when they did it. I've got one copy left. And in that study, and Jeff Christian, by the way, has put this in his yearbook a few times. I don't know if it's in 2011. I just got my copy today. But regardless, all of history says that there were 42 billion ounces, 42 billion ounces of silver that have been brought up out of the earth in all of recorded history. And if you look at gold, depending on whose study you use, but I'm going to use 7 billion ounces as an example of all the gold. So 7 goes into 42 6 times. So if you want to know what the ratio is, you look at what the ratio is. You look at 42 billion divided by 7 billion, you get a number of 6. So it's a factor of 6, not 16. If you say, well, you were too high on gold, it was 6. Okay, there's 6 billion ounces of gold. Then it was a 1-to-7 ratio. Or maybe you say, well, it wasn't even 6, there's only 5 billion ounces of gold. But my point is it's not 16-to-1. That is not the natural ratio. So that's one point. Now, the other point, these markets should trade based upon what their scarcity ratio is. And that's ridiculous. That's not how markets work. It's like if silver is 1/6 as rare as gold, so 6 gold is 7 times more rare than silver, then the price of gold should be 7 times silver, or conversely, silver should be 1/7 the price of gold. That is not how markets work. For example, quickly, in the metals market, platinum is 15 times scarcer than gold. 15 times. And yet you don't see platinum at 15 times the price of gold. So markets don't work, and people that use that kind of analysis to determine what the price should be might be using it valid or invalid. I don't take it very valid, and I want to be consistent here because I've used the ratio myself. And the reason I use it is because it's a measurement to determine which one is doing good or better than the other one. That's a fact. That's a math problem. It's a division problem. Any third grader can do it. And right now the ratio is 40-to-1. When I started my service, it was about 80-to-1. So what that means is, even though we've had this correction in silver, if you put the same amount of money in the gold and silver, that your silver investment has outperformed your gold investment by a factor 2-to-1, and that's in the metal itself. And I'm not going to bother with the stocks because that's a whole different issue, and it isn't the way you look at it. You look at it metal to metal. So those are two things that I just really kind of been pent up in me, Jim, that, I asked you if you'd give me the forum to talk about it, because I question anybody that starts writing in the arena, and I'm free market. I mean, anyone can put their opinion out there. That's fine. But when they get fact after fact after fact wrong, it really starts to grind me after a while.
Well, let's talk about another issue, because everybody is aware that last year the trade was silver. Silver was up 80%, and for up until a couple of weeks ago, the trade of the year again was silver. It was up almost 50%. If you take the gains from the lows of last year, it was up 84%. And I was interviewing a futures trader, and I was asking this futures trader, and I said, look, anytime you see something that goes parabolic, how do you know, looking at the charts, that you're going to wake up tomorrow morning and they're going to slap on margin controls? And he said, anytime you get a market that goes parabolic, that becomes unbalanced, and a ton of spec money comes in at the very end, pushing it up, he said, you can bet that they're going to slap margin requirements. And not only did they do that, it took them, 4 or 5 times, Dave, but it just wasn't silver. So you've got all these conspiracy theories that this was a secret plot to save J.P. Morgan or to protect J.P. Morgan. But, Dave, I saw them raise margin requirements on silver. I saw them raise margin requirements on oil. I saw them raise margin requirements on the ag sector. And explain to our listeners that that's what they do. Did they let it go so far like they did? What I suspect, Dave, is unlike 2008, where they didn't slap any margin requirements on oil until the very end, when I was up at 147, I think they're a little bit more proactive now.
I agree with your assessment. I mean, it's anyone that's been in the futures market seriously and isn't a casual observer realizes that that's what they do. And we anticipated it for, our readers. Going back, a funny story, Jim, just on the side that verifies the point. Flaxseed, used to call it rapeseed. It was a Canadian futures market, and that probably had the biggest move of any market I think I've ever seen. Very tiny, tiny market. I mean, it's ridiculous they even have it on the futures exchange, and they don't anymore. But same thing. I mean, these markets get out of control, and the people that run the exchanges have vested interest in these markets that they don't get out of control. So the way to calm them down is to deleverage them, and deleverage means you have to put up more cash. I mean, if the silver market or the corn market, for that matter, was a cash-only market where there was no leverage, there was no futures market, it would be a different animal. The reason that you get such wide swings in oil, as an example, is because of all the speculators, and that offs the risk of the producers. I have nothing against the way that the futures market was set up in the original intent, and I don't have a whole big problem with it now if you read the contract. Where my issue is that people that are in the futures market or don't participate, that have all kinds of commentary about how it should be done or could be done or might be done or, this conspiracy or that one, and have never even bothered to read the contract. I mean, if you're going to sit down and play the game of Monopoly, and then, halfway through the game you start making up your own rules and tell your fellow players how it's supposed to be because and what kind of a game is that? If you're going to be in the COMEX, you're going to be in that game, you darn well better know what the rules are. I don't know. I'm not trying to be on the side of the COMEX necessarily, but I'm also an adult. I mean, if you're going to play the game, you better read the rule book. What do you think, Jim?
Well, I've been in the securities business 30 years, and we have rules, and that we've seen over and over again when a market becomes unbalanced. It's one of the criticisms, Dave, that was leveled on the credit crisis, that the regulators, instead of allowing these investment banks to go take these leverage positions 40-1, we saw a company like AIG that writes $500 billion of credit default swaps, and nobody was saying anything. That's how you get in those kind of messes. So it's a natural thing that I think that investors need to be aware of. And Dave, it just doesn't apply to the commodity markets. It could be internet stocks. It could be Chinese stock. Just a couple of years ago, it was 2007 or 2008, the Chinese market was on fire. It was going ballistic, up over 100%. Well, guess what? It fell, which is gravity takes over. I want to talk about something else, too, here. And this is a question that we get a lot of. I'm just looking at the bullion prices for the year. We've got gold up 5% and silver's up about 13%. A lot of people are saying, isn't there a problem? Why haven't the gold stocks gone up? Why haven't the silver stocks gone up? But Dave, you remember what it was like last fall, and from September to December. A lot of these stocks were up 200, 300%. And you have to ask yourself, if somebody producing 7 million ounces of silver a year is really worth $2 billion in market cap.
Oh, exactly. I mean, we look at the list that's in our model portfolio, and we've had some, for example, I'll just give one out. It's no mystery, and most people that are halfway attuned to the silver market knows the company, First Majestic. We had that on our list for $4, and you could have bought it under $4 for a very long time. But I knew the fundamentals, I knew the management, I knew the production rate, I knew everything about that company, basically. I mean, as much as you could. That company went up to well over 20. But we were patient, Was it a buy, at 20? No, I think it was a sell. Now, as that company started to accelerate, my conservative nature for our members is to take some money on the way up. So I suggested to everybody, and I don't know what they did or didn't do, was to, they got a quick double here to take, that original capital out of the market and let the rest run. And there's a couple of reasons for that, Jim, and it's not picking up First Majestic, but it applies across the board. There's a lot of risk in today's world. I think anyone listening to your show understands that. And this mining nationalization issue that came up recently in Bolivia, I mean, there's a lot of worry about those issues, not only in Bolivia, but in Venezuela and also in Mexico from time to time. So when you have the ability to lower your risk profile, I think it's prudent to do so. So anyway, just back on point, that's how we did it. That's one example, and I'm just backing you up that, these stocks did perform for the most part. Not every single one across the board, but many of them performed and did anticipate basically higher prices. So now that the market's calmed down, so have the stocks, but there are issues that are very good purchases right now, but I think the best thing to do if you're prudent and you have a longer-term horizon than getting rich next week would be to filter in during the summer months. That's usually when you're going to get the best buys on these stocks anyway.
Dave, explain for our listeners somewhat of the seasonality of the gold and silver stocks. I know we have fall buying for the Christmas season coming in with jewelers. We have India's buying that comes in with the wedding season. Explain some of the seasonality that we see and why it's fairly predictable.
Well, for the two reasons you gave, I mean, I've always, since I started in this industry so many years ago, I noticed after a while, on my own, that, every summer, a big geopolitical event would happen, and gold really wouldn't do anything. It'll be like August. I'm going, what is going on here? And after learning more and more, I discovered that there's a pretty good seasonality about the metals. The main reason given is that there's so much done throughout Europe and the Middle East, and they take these very long vacations, and no one really trades near the volumes. You can check that. That is part of it. I don't know if I have an absolute why. I'm more interested in, I don't really need to know why. What I really need to know is what the historical performance is that is going to help me trade better or make more money. And the answer is, you always seem to get summer doldrums for whatever the reason.
Well, maybe we'll get another chance this summer. I mean, we certainly have the commodity complex, which has had one heck of a run-up since 2009, as many other asset classes have. Dave, in this kind of environment, let's get back to just bullion. I noticed that the premiums on the sovereign coins, they're still there. They've come down, not as bad as they used to be. Last time you were on the program, we recommended if people were accumulating bullion, the best buys were in what we call junk silver. That's the pre-63 coins. Does that still hold true?
It still does. And there was one more issue that we talked before we started the show I'd like to address real quick, and that's backwardation. There was backwardation, but not to the extent that a lot of the writers were implying. I mean, and we had that in oil when we had the 147 move. I don't read a lot of the oil sites, so I don't want to misspeak this, but the implication usually is that it's a one-way street. In other words, any backwardation means that the commodity is in such short or tight supply that whoever needs it now is willing to pay more. And that's not an untruth. But it also could imply that there's a lot of supply coming on board later. And very few people take that viewpoint. But Ned Schmidt, who I think writes on your site from time to time, brought that up. The point I'm making is, what is a fact? And the fact is, when the oil hit 147, there was pretty good backwardation. And then remember, it fell to 110 before it dropped all the way down into the lows that we saw over months. But it dropped very dramatically, very quickly, similar to what the silver market did recently. And we don't hear a lot about this backwardation now. Now, I also have to be complete here that the silver market, from the fundamental analysis, which I continue to do and update regularly, is still a rather tight market, but doesn't imply that every last ounce of silver is so tightly held that you've got to pay a premium to get it today. That's not the case.
All right. Well, listen, Dave, as we close, if our listeners would like to follow what you do at the Morgan Report, you've got two websites, so tell them the difference between both of them and how they can find them.
Okay, great. Easiest one to get on the free mailing list, just go to themorganreport.com, sign up to get the 10 rules of silver investing for free. Also get a couple of videos I did several years ago, but most of the information is still basic fundamental analysis on the silver market. And for those that want a dollar cost average into the silver market and get a pretty good price on your metal, you can go to silver123.net. That's silver123.net. It's a silver savings program. They also offer gold. You can have it stored or delivered, knowing these guys from the inception, well before the inception, actually. I invited them out here to Spokane last year for the Silver Summit. We plan on doing the same thing again. So if you want to meet who you're dealing with, shake their hand, talk it over with them, whatever, we'll have them again here in October for the 2011 Silver Summit.
We've been speaking with Dave Morgan at the Morgan Report. Dave, as always, thanks for joining us on the program.
Thanks, Jim.
You're listening to Financial Sense Daily Edition at financialsense.com.
Well, for a while, it looked like oil prices were heading for that level of $150, $126. Now we're back down. Gold has come down. What's going on? Chris Vermillion, the Gold and Oil Guy, joins us. And Chris, let's begin with the gold market and silver market. We saw just some fabulous returns from silver, almost up 50% for the year before the pullback after an 80% run last year. Let's talk about where we go from here.
Yeah, well, I think silver obviously had a huge run in the last, more or less, 8 months, and I think we've seen a lot of speculative money jump into silver. It was a pretty small market, pretty quiet for a long time. It does have a lot more volatility than gold, but pretty much everybody started moving into silver in the last 6 months or so, and it's just been on fire. And I think that wave of buying, finally there was so much gains. I think we've just seen some big money unloading and pocketing a lot of profits, and it's definitely hurt the price of silver, dropping from $50 to about $34 an ounce in the last month or so here. Same with gold. Gold's done a pretty similar thing, but of course it's not as volatile, and it's actually holding up relatively well still.
So, Chris, do you think when you have a sharp run-up like that, and you've had a little technical damage here when we've gone from, 48 down to in the 34, 35 range, does it just consolidate here, or could we head lower?
Yeah, silver, I think, is trying to bottom here. I think it's bottoming around the 34, 35 area. There's a lot of distribution selling that took place, and there's quite a bit of damage to the chart done. But I feel as though we're going to see something similar to 2006, what we saw in silver, where it's going to consolidate, I think, for a good 8, 12 months, possibly even more. I know a lot of people are bullish on gold, and I think that's silver, and that's one of the reasons why I think it's actually ready to consolidate. Simply, the money poured into silver, went straight up, went parabolic, and then just came straight back down. And that's a sign that, market's becoming very volatile, unstable. There's waves of buying and selling. I think it's going to consolidate in a fairly large range, mind you. It's, trading between 48 and 34. So there's a lot of play in there still for some pretty decent gains throughout the next 8 to 12 months. But I think more or less it's going to be trading sideways in some chops. So.
And of course, we saw not just silver pull back. We saw margin requirements go up not only on silver, it went up on energy, it went in the ag sector. So what's your take on energy? It seems like we're kind of hovering here in that kind of like 98, 100 zone. Do we go higher, lower, or just stay here?
Yeah, I think we're going to see crude oil I think we're going to see commodities across the board more or less kind of go flatline for a while. I think they're going to chop around. Commodities are still, in my opinion, a little bit overdone. They got bought up pretty good. They have had, everything's pretty much pulled back pretty sharply on the commodity side. But I don't think we're really going to go too much lower in commodities. There may be one more small wave lower in the next month or two or going into the summer here, but nothing substantial. And then from there, I think we're going to form a nice base and pretty much trade sideways to up for the next probably 12 and 24 months, I still think they're a very solid play, the commodity market.
Well, the big gorilla when it comes to commodities is China. And China keeps raising bank reserves. They keep raising interest rates. And, Chris, we have a saying here on the program, central banks keep raising interest rates until something breaks. Either something breaks in the economy or something breaks in the markets. Now, last time they did that, China's economy came virtually unscathed during the credit crisis in 2008. I mean, they still grew at a respectable rate. They haven't had a problem. But in China right now, you've got a property bubble. And how long can they keep doing this before they do have a hard landing, not a soft landing, as many would expect?
Yeah, it's a tough call for sure. I'm not really sure what's going to happen over there. You know, they're going to keep rising rates. It is eventually going to cause an issue for sure, and it could only get worse. So I think there's some choppy weather ahead for China right now. When
you see, as you just spoke about, a choppy market environment where we just consolidate here for a while, up one day, down the next, really don't go anywhere, how do you invest or trade that kind of market?
Overall, as long as you're trading in an overall bull market or an uptrend in the previous leg, which we've seen everything have a nice run up, pretty much you're looking to buy. I focus myself on market sentiment and volume analysis and a lot on the options market to try and load up on positions or accumulate positions on substantial drops, high volume sell-offs down into support zones. So I pretty much look for fear in the market, and it actually has pretty predominant price patterns on the intraday patterns charts where you can actually see waves of fear hitting the market. And these waves of fear usually last for about 5 to 6 trading sessions, and I can kind of see it coming. I look to accumulate on new lows, on high volume, and usually you'll see it start to bottom out. So it only happens, every month or two. You see these little waves of selling in the market, this panic of people starting to become bearish, and that's actually when I start to accumulate. And that's what I actually look for, these dips to the market when there's actually some rising volume, and usually small technical levels have to be taken out. Usually spots previous pivot lows, I like to see them pierce to the downside, so it actually flushes out stop orders, and people start to think, well, now we've got a lower low, the trend's going down. That's when I'm actually accumulating, because the overall trend long-term is still up, and the market likes to flush and shake traders out of their positions. So that's what I wait for, these little technical breaks, nothing substantial like on silver, which had a very strong technical break, and it's pretty much in shell shock right now trying to base and stabilize. Overall, in a choppy market, I just look for these small technical levels to be broken intraday or for a day or two, and usually I'll see the fear in the market creep in, and I'll start to scale in, and then usually it'll recoil and start to bounce for another 3, 5, 10%. That's what I look for in a choppy market.
Now, when you say that they're going to consolidate in this pattern here for a while and then eventually back up again, what gives you that confidence to say that? Is it something you're seeing in the chart patterns, a long-term trend that you're going on? Explain that.
Yeah, it's previous price action on the charts, and the fact that I'm very technical based, and the charts, especially on silver, are stretched beyond their limits really to the downside. And the last week or so here, it's actually showing signs of that momentum is slowing, and you're seeing smaller waves of selling and you're seeing larger waves of buying, but it just hasn't got the momentum yet to finally form a base here and put a nice bounce in silver. And that's the same with gold. So I'm just kind of waiting for these extreme levels to finish, the fear to finish kind of panicking out of the market. And once that momentum comes to a grinding halt almost, or does shift to the upside, that's when I look to jump on board a bounce and possibly even a rally to new highs. So that's how I kind of play that.
When you see extreme moves, I don't care whether it's looking at the oil charts as we saw in 2008 where we were under $100 and went straight up to 150, or you're below $20 on silver and you go all the way up to $48 an ounce. When you see those extreme moves, do you ever take a short position?
Oh, yeah. I would rather short any day over go long. I prefer trading fear than I do greed. Greed seems to drag out and is much slower to move, harder to read tops. But so once you're in a downtrend, fear sets in, and you usually get very sharp moves. And I'm a very short-term trader when it comes to trading on the downside. I look at the charts on various time frames, anywhere from the 1 minute all the way to the 60 minute, and I look for these waves of fears hitting the market in different levels. and I just ride the fear, and trading fear is very predictable compared to greedy traders, more or less, in an uptrend that just keeps grinding and grinding. So I'm a very avid short trader. I short gold. Even on the big days that it's up, I'm usually in there taking small short positions just for these counter swings, because I can actually see when fear's creeping in and we're about to a sharp little drop. And I like to short gold quite a bit on an intraday basis, simply because traders who trade gold seem to place stops under short-term pivot lows. And while there is quite a bit of liquidity in gold, gold still drops very sharply when it breaks these little key pivot lows. And I look for those flush outs of selling, and I actually kind of quickly take gains on those drops. So I'm a very avid short, and the big drop in oil there from 150 or 145 all the way down to $40 a barrel, that was an incredible drop, and I was definitely aggressive in there.
So at this point, given where the markets are you waiting for things to sort of settle in, the last of the fear sellers to finally dump their positions and then start building new ones?
We started to scale into a long position on the SP 500 on Tuesday morning. We scaled in. There was a nice final wave of fear there. Since then, we've seen the market rally, or not really rally, more or less a bounce. I'm waiting for the rally to kick in. There could be one more wave of fear in the market. If we see the broad market dip down, I'll be looking to scale in a bit more to cost average down into that fear. But for precious metals, I think they're trying to bottom. I do feel as though there could be one more little squeeze to the downside, just enough. The drops that happen in precious metals right now, and same with crude oil, was more than enough to get everybody's attention that this trend could be over. And the market is stabilizing. It's starting to feel as though it wants to bottom. It looks like it wants to bottom, but everybody, a lot of people now are changing their minds and going bearish. So I'm just kind of waiting for that one more squeeze lower if we can get it. And I think that's going to be enough for most people to just pull the plug and say, get me out of gold and silver and oil, and that'll be the final flush. So I'm hoping we get one squeeze lower, which it'll be a drop of anywhere from 2 to 5%, and then we'll see a nice move back to the upside. But accumulating at these prices, I think, is actually a pretty solid play for starting into a long position into silver or gold, too. So I just think there's a little bit more downside, and I'm a short-term trader, so I do like to try and squeeze as much out of a play that I can.
Now, you're more of a short-term trader, but if you're looking at long-term charts, if we were looking out towards the end of the year, would you expect silver and gold to be higher from where they are today?
I would, yeah. I would expect gold to be pretty much flat. As for silver, I think silver should be trading up probably around $38.40 an ounce. I think there's a little more upside to silver. It had such a sharp drop that I think it's going to reach equilibrium somewhere around the 38 to 42 range going through the year, while I think gold could actually trade really flat, maybe even possibly a little bit down going into the year end. So,
well, listen, Chris, if our listeners would like to follow the work that you do, why don't you give out your website and tell them what they'll find there?
Sure, yeah. I provide research, morning videos, and trade alerts at thegoldandoilguy.com. And pretty much it's a financial newsletter with video content in the morning. So every pre-market, I do about a 8 to 15-minute video recapping everything that's happened through the night in futures for crude oil, the dollar, precious metals, the bond market. I cover all that stuff and kind of explain what I expect to happen through the day, key levels of support and resistance, and, you know, how to take advantage of it. And then throughout the day, I update subscribers as things unfold, pointing out new opportunities and how to manage positions if we're in any positions, adjusting stops and profit targets and things like that. So it's a pretty interesting newsletter simply because it has a mix of video and regular updates. And, of course, I focus on replying to every subscriber. So every email you get replied back is actually from me. That's one of my main things. I enjoy helping traders. I enjoy speaking with traders. It's just my passion, and that's why I run the newsletter.
All right. If you'd like to follow Chris's work, simply go to the Gold and Oil Guy, the Gold and Oil Guy, all one word, thegoldandoilguy.com. Chris, thanks for joining us on the program.
Thanks, Jim. Appreciate it.
You've been listening to the Financial Sense News Hour with Jim Poplava. The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell securities. Responses to listener inquiries are based on the opinions of Jim Poplava and do not take into account listeners' suitability, objectives, or risk tolerances. You should always consult a qualified financial advisor before making investment decisions. Financial Sense will not be liable to anyone for financial losses resulting from companies profiled or information provided on this program. The Financial Sense News Hour was produced by Steel on Steel Productions. Join us again throughout the week for more in-depth news and financial analysis at financialsense.com.